When the media reports on the stock market, they typically talk about the Dow, the S&P, and the Nasdaq. But when it comes to these three indexes, there can be more risk there than meets the eye. Now, when I talk about the stock market, I break it up into quadrants called the multi-factor model. You have large companies versus small, growth versus value in both the US and internationally. Now, as you often hear me say, there's higher expected returns in small companies versus large, higher in value versus growth. And we can look at these in 8 different quadrants. Now, one of the things that we looked at, which I think is really interesting, is 5-year rolling periods in each of these 8 asset categories, just to see how many 5-year periods they had negative returns. And what surprised me was that the winner was actually large US growth companies with 7 negative 5-year periods. Now that compares to 4 in most other areas and 1 in international small and international small value. So there may be a lot more risk there than meets the eye concentrating all your money here. Now this is what American investors tend to do. They tend to focus on just this one area and retirement plans in particular. Now if we look at those 7 5-year periods and just see what happened during those 7-year periods versus other areas of the stock market, you see something interesting. Did they all go down together? And the answer is no. The first period is 1970 through 74. You see large US stocks, which is the lower left-hand quadrant on the left-hand graph, went down, but large value actually went up. And all international asset classes went up, as you can see right here. How about the next period of time, 73 through 77? Large US down. Every other area of the stock market, both in the US and internationally, went up. How about 98 through 2002? Again, large US and large international growth went down, but every other area up. How about 99 through 2003? We see large US down, every other area up. And how about the tech bubble, 2000 through 2004? Large US, large international down, every other area up. And you're starting to see why it's so important to diversify, because they don't all move together. How about January of 2004 through 2008? Again, large US value up and all international asset categories up. Why? Well, because the dollar was actually weakening versus other currencies. That's one of the reasons that it actually happened. So you can see it's really important to make sure you're globally diversified. How about 2007 through 2011? Well, all areas of the market were affected by the financial crisis and the banking crisis, so they all went down for that 5-year period. Now, if we look at the Trump presidency, and I started the data from December 1st through November 30th of 2020, and looked at what areas of the market did really well and how they did, you'll notice that US large stocks dominated during that period in time. And in particular, some of the companies that really did the best are what we call the FANMAG companies. Facebook, Apple, Amazon, Netflix, Google, and Microsoft are those companies. And if we look at what happened during that period of time, they caused that one area of the market, large US companies, to do much better than other areas. Now, what you might be tempted to do is go, well, I'm really comfortable. I know these companies. I've heard of them. I've worked with them. I buy their stuff. You may want to actually look at some of the changes that have been taking place so far this year, and particularly in the last month. The Wall Street Journal actually wrote about it, and they said the stock market's rally is finally widening. Well, what are they talking about here? Well, if you look at the month of November, large US stocks were the worst performing area of the market. You may have heard that they had a record month, better than in the last 30 years, but other areas actually did better, but nobody reports on them. So make it a real, make it a priority to make sure you're not just concentrated in single areas of the stock market. It can be really dangerous. And realize that there may be more risk just concentrating on those big US companies than meets the eye.